Imagine you've spent the last 30 years of your life building up your business. You've worked through economic downturns, you've hired a great bunch of staff, and you've built some real strong customer relationships. You've taken a whole pile of risks that most people would have never considered. Then one day, your phone rings up. Someone wants to buy your business. At first, you think, hey, this is pretty exciting. Then you begin to wonder what your company might be worth. But then something unexpected happens. Another company expresses interest in buying your business. And then maybe a third. The surprising part of all of this is what? That each buyer values your business differently. One may offer substantially more than another. You probably say to yourself, how is this even possible? After all, they're buying the same business, are they not? The answer is that they're not all buying it for the exact same reason. Welcome back to Legacy, the Business Succession Podcast. As always, I'm your host, Jared Pilon. In our last episode, we talked about how the right corporate structure can create flexibility when you're in that transition period. Today, we're going to take the next step forward. We're going to discuss strategic buyers, why they sometimes pay significantly more than other purchasers, and what you can do today to maximize the value of your business long before you ever decide to sell. Let's get into it. One question I get asked all the time is this: Jared, what is my business worth? People are usually expecting me to give them a multiple of EBITDA or some rough estimate. Instead, I usually answer the question with another question: who's buying it? Because the value of a business isn't determined solely by its financial statements. It's determined by what that business is worth to a particular buyer. And that is an important distinction that I want you to know about. Two buyers can look at exactly the same company and arrive at two completely different values. Let me give you a real-world example. I worked with a client who attracted interest from several potential purchasers. On paper, everyone was looking at the exact same business. Had the same revenue, the same profits, the same group of employees, the same underlying assets, but one buyer was willing to pay considerably more than the other one. Now you ask yourself, why is that? Because they weren't just buying another business. They were buying an opportunity in my client. The operating company already operated in that industry. My client had developed a specialized product and a unique method of delivering that product to the market. By purchasing the business, the buyer immediately gained a new product offering that they could introduce to their existing customer base. At the same time, they could introduce their own products and services to my client's existing customer base. Instead of 1 + 1 = 2, in this case, 1 + 1 = 3. That's what we mean when we talk about synergies. It's simply the additional value that's created when two businesses are combined. Those synergies didn't exist for every buyer. A management team couldn't create them. A family member couldn't create them. An employee purchasing the business couldn't create them. But this strategic buyer could create those synergies. And because of that, they were willing to pay more for this particular opportunity. That's one of the biggest misconceptions I see among business owners. Many assume there's one market value for their company straight up. In reality, there's often a range of values that apply to your business. And where your business falls within that range depends on who's sitting across the table from you. So what exactly is a strategic buyer? A strategic buyer is usually another business that's looking to strengthen its own position. Maybe they're entering a new geographic market. Maybe they're looking to eliminate a competitor. Maybe they just want to gain some experienced employees. Or maybe they want to access your customer relationships. Lastly, maybe they're interested in your products, technologies, or processes. Overall, they're just looking for an opportunity that maybe someone else can't see. Compare that with a financial buyer. A financial buyer is generally purchasing your business as an investment. They're focused on a return on that investment. They want to see cash flow. They want to see the underlying risk inherent in your business. They want to understand where your future earnings are going. Strategic buyers certainly care about these things as well, but they also consider what your business allows theirs to become. That's why strategic buyers are often willing to pay a bit of a premium. Over the years, I've noticed three things that strategic buyers consider on a regular basis. The first is price. Even strategic buyers aren't going to overpay. They still want to know that an acquisition makes financial sense to them. They're evaluating how quickly they'll recover their investment and what return that they're going to see over the long term. The second thing that they look at is transferable value. Years ago, many successful businesses were built almost entirely on personal relationships. Deals were made with handshakes, customers worked with people that they trusted, and there was really nothing wrong with that. But today's buyers often want to see more than that. They want to see customer contracts up front. They want to have supplier agreements in place. They like to see that employees are also under agreements. Documented systems matter to these buyers. They want to see strong policies and processes. They want to have some sort of backup for that IP property. Anything that allows the business to continue operating successfully after an ownership change is beneficial. The less dependent the business is on one individual, i.e. you, the owner, the more valuable it often becomes. The third thing strategic buyers look for is a strong management team. I've often told clients that buyers want to invest in a business. They don't want to purchase another job. Think about that for a minute. If you're buying a company and every decision still goes through you as the owner, every customer relationship depends on you, the owner, every operational issue lands on your desk, what happens if you leave that business? Well, the business suddenly becomes extremely risky. Now compare that to a company with experienced managers. It has clear leadership guidelines. It has documented processes throughout. Decision makers who are already running the day-to-day operations, and that becomes a very different investment. And buyers will definitely recognize that. One mistake I see business owners make is believing that finding a buyer is the hard part. Generally speaking, it isn't. Once a buyer is interested, that is when the real work begins. This stage is commonly referred to as due diligence. Think of it as the buyer verifying everything that they have been told by you. They're going to ask for your financial information, your tax returns, probably your corporate records to verify shareholdings. They'll want to see those employment agreements, customer contracts, supplier agreements, a listing of your equipment, an understanding and verification of your lease agreements, your insurance information, various legal documents, and potentially some environmental reports given the industry. The list can be surprisingly long. The businesses that move through this process more efficiently are almost always the ones that prepared long before they ever received that offer. Their records are organized, their financial information is current, their corporate minute books are complete and up to date, major agreements are signed and readily available. When buyers ask questions, they receive answers quickly. This builds confidence in that due diligence process. On the other hand, when information cannot be found or nobody seems to have an answer to the questions that are posed, or potentially documents have to be recreated after the fact, buyers typically begin asking themselves another question. What else don't we know about this business? Preparation creates confidence. Disorganization creates uncertainty. There's another side of selling a business that doesn't get discussed very often, and that is the emotional side. Selling a business isn't just a straight line. There are exciting moments. You'll receive an offer. The negotiations might go well for a little while. That buyer is probably enthusiastic to begin with, and everything seems to move forward quite smoothly. Then suddenly, some due diligence uncovers an issue that you may not have anticipated. Lawyers probably need to get involved in a more in-depth process. Negotiations can slow down. The buyer starts asking some difficult questions, and it can feel like the deal is falling apart on you. But then it might move forward again. That's normal. Almost every significant transaction has highs and lows. One of the biggest benefits of surrounding yourself with experienced advisors is having people who can help you navigate these moments without making emotional decisions. Over the years, I've developed a few pieces of advice that I almost always share with clients before they begin talking with buyers. Number one, let the buyer make the first offer. Too many business owners rush to put a price on their company before they understand how that buyer is going to value it. You may unintentionally negotiate against yourself. You don't need to do that. Allow that buyer to show their hand first. Second, never agree to terms until both your lawyer and a CPA have reviewed them. The purchase price is important. It's not only one part of the transaction, but there are things to consider such as working capital adjustments, vendor financing, earnouts, restrictive covenants, representations and warranties, timing of payments and deposits, indemnities. All of these can dramatically affect the outcome of the deal. Third, understand the after-tax implications before agreeing to a structure. There is a significant difference between an asset sale and a share sale. The highest purchase price doesn't necessarily leave you with the most money after tax. Knowing your after-tax outcome before you begin negotiations allows you to make a much better decision. And fourth, make sure you know your numbers. I encourage clients to prepare an adjusted EBITDA calculation before they go to market. Having your own benchmark in place gives you that starting point when you start evaluating offers. It doesn't necessarily determine the value, but it helps you to understand whether an offer even deserves serious consideration. Fifth, be organized. Before someone even asks for information, be organized. Don't wait until after that offer arrives to begin preparing your records. Preparation can take a lot longer than people expect. Finally, make sure you are protecting confidentiality. Business sales can create uncertainty among employees, among customers, and suppliers. Before sharing any confidential information with a prospective buyer, I would suggest that you get an appropriate non-disclosure agreement signed and in place. Protecting your business during negotiations is just as important as negotiating the purchase price itself. If there's one philosophy I'd leave you with today, it's this: the best business sales don't start when that offer arrives. They start years earlier by building a business that's organized, transferable, and attractive to buyers. That is how value is created. And that's how you put yourself in the strongest possible negotiating position. So let me leave you with 3 takeaways. Number 1, different buyers can dramatically value the same business at a different amount. Understanding who your ideal buyer might be is one of the most important parts of your succession plan. Number 2, preparation creates leverage. The more organized your business is before negotiations begin, the smoother that due diligence process usually becomes. Number 3, remember that the best transaction isn't always the one with the highest purchase price. It's the one that helps you achieve your financial goals while protecting your legacy, your employees, your customers, and the future of the business that you spent years building. If today's episode made you think differently about selling your business, I encourage you to download our business succession planning ebook. It's designed to help you, the business owner, begin preparing for that transition long before it becomes reality. You can download it today at legacyllp.ca. If you found this episode helpful, please subscribe and share it with another business owner who might also benefit from it. In our next episode, we'll discuss how business owners can begin preparing their companies years before a transition to maximize value, reduce risk, create options when time eventually comes to exit. Thanks again for listening. As always, I'm Jared. And remember, if you're building something meaningful, it deserves a thoughtful transition. I'll see you again on the next one. Take care.